Hi, I'm Tim Kelly from the Montgomery Fund, and welcome to this week's Video Insight. Today I want to talk about something that a lot of investors are interested in, especially those investors that rely on their share portfolios for regular income, and that's dividend yield. In an environment of low interest rates, as we've seen recently, dividend yield has been a focus for a large number of investors, but there's at least a theoretical risk in choosing shares for their dividend yield. And that is the risk that if the company pays out too much of its earnings as dividends, it doesn't have the ability to reinvest for growth. And that could mean that the dividend doesn't keep up with inflation, or worse, that the dividend falls over time. So how should investors think about dividend yield? Let's start by looking at the historical evidence. When we analyse the investment performance of Australian shares over the last decade, we find that companies with a higher dividend yield have been better investments than companies with a lower dividend yield. But there are some important caveats to that finding, as this chart shows. What we've compared here is the risk-adjusted investment performance of companies in the top decile in terms of dividend yield, in orange, with the performance of companies in the bottom decile in terms of dividend yield, in blue. And you can see that there has been a wide gap in performance, with the top dividend yield stocks doing a lot better than the bottom decile companies. All else equal, that tells us that investing in dividend yield has been a good strategy, but there are some important points to keep in mind. Firstly, almost all of that performance differential accrued between 2011 and 2014, a period when the RBA was lowering interest rates. It may be that during this period, investors found that they could no longer earn enough income on cash, and so a preference for dividend yielding shares emerged. If that's the case, it's possible we could see an unwinding of that previous outperformance for dividend stocks in the event that interest rates rise. There's another important finding that emerges when we look closely at this data, and that's this. The outperformance of higher yielding stocks is not driven as much by the strong performance of the high yield stocks as it is by the poor performance of the very low yielding stocks. The analysis shows that companies with a high dividend yield are okay, but companies with a very low dividend yield have tended to deliver very weak total returns. There are a few reasons this might happen. One is that dividend yield tells us something about valuation, and an extremely low yield can be a sign that a stock is overpriced. Also, companies that pay no dividend at all often have a very exciting story to tell, but usually don't have much by way of actual cash earnings, and it's easy for the market to get excited about a good story and to push prices ahead of reality. Taking all of that into account, it seems like a good approach for investors is to be sceptical of companies that have a non-existent or a tiny dividend yield, but also to be a bit wary of companies that have a very high dividend yield. While some of those high-yielding companies will turn out to be good investments, a high dividend yield alone is no guarantee of good results, especially if we find ourselves in an environment of rising interest rates. That's all for this week, but we'll be back with more next week. And in the meantime, you can follow us on Facebook or Twitter.